Crypto was introduced as a revolution, a system designed to break the chains of traditional finance. It promised freedom from banks, freedom from governments, freedom from institutions that had controlled money for centuries. For millions, crypto was not just technology, it was hope that money could finally belong to the people, not the powerful. The idea was simple, yet powerful. A world where transactions could happen directly between individuals without asking permission from banks or governments. No middlemen, no central authority, just mathematics, cryptography, and trust in a decentralized network. But beneath this powerful narrative was a question few were willing to ask. Was crypto truly designed to create financial equality, or was it simply creating a new system where power concentrated in the hands of a few, hidden behind code? In almost every financial system, the biggest winners are determined early, those who enter first, who control supply, who understand the system before the crowd arrives. By the time most people bought their first coin, the rules of the game were already set. This is not hype. This is not investment advice. There will be no predictions, no promises of quick wealth. What follows is the story of how crypto really works, beyond headlines, beyond the hype. To understand crypto, we first need to see the world before it. Money controlled by central banks, governments deciding who can access it, ordinary people with almost no say in decisions affecting their savings and future. For decades, banks were seen as trustworthy. People deposited their savings, believing it was safe. Behind the scenes, banks were lending far more than anyone realized. The system worked, until it didn't. In 2008, the global financial system collapsed. Major banks took reckless risks, millions lost jobs, homes were foreclosed, savings disappeared. Yet governments chose to rescue the very institutions that caused the crisis. Trillions of dollars were created to save banks. Inflation followed. Ordinary people paid the price. Trust in banks collapsed. Faith in governments weakened. And in this environment of anger and disbelief, a new idea began to emerge: cryptocurrency. In October 2008, Satoshi Nakamoto published a 9-page document, the Bitcoin White Paper. No bank, no government, no permission, just code and mathematics, quietly challenging the entire global financial system. Bitcoin proposed a peer-to-peer system, transactions without middlemen, without censorship, without centralized control. For the first time, money had rules enforced by code, not humans. Only 21 million bitcoins would ever exist. No printing, no bailouts. Money with a hard limit, immune to human manipulation. For the first time, scarcity and trust were embedded in the protocol itself. In January 2009, the first Bitcoin block was mined. Hidden within it was a protest against financial injustice, a subtle reminder that banks were rescued while people suffered. In the beginning, nobody cared. Bitcoin was mined on laptops by hobbyists, programmers, and believers in an idea, not profit. The first transactions were experimental. Wealth was not the goal. Freedom was. Everything changed when Bitcoin gained attention. The media called it digital gold. Speculators arrived. Greed entered the system. The question shifted from why does Bitcoin exist to how fast can it make me rich? The truth is harsh. Crypto markets may be decentralized in technology, but wealth is highly centralized. A small number of wallets, known as whales, control a massive share. They influence every rally, every crash, and every emotional swing the market experiences. Bitcoin inspired thousands of altcoins, Ethereum, Ripple, Litecoin, and millions of others. Each promised a revolution: faster transactions, cheaper fees, smarter technology. Few delivered. Most created a speculative frenzy. The ICO boom of 2017 allowed anyone to raise millions with a website and a promise. White papers replaced real products. Marketing replaced fundamentals. Millions poured in, hoping for overnight wealth. Most projects failed, leaving investors empty-handed. Retail investors took the highest risk and entered last. They believed in hype, in influencers, in promises. But by design, the smart money was already exiting. Risk was socialized, rewards privatized. As crypto evolved, so did its complexity. Leverage, derivatives, and high-frequency speculation created a market driven by emotion, not fundamentals. Most investors did not realize they were participating in a global casino. Market crashes became a regular phenomenon. Prices surged, then collapsed overnight. Each cycle repeated the same pattern: hype, greed, euphoria, and then despair. For most, it was devastating. For a few, it was opportunity. Retail investors followed emotions, not analysis. They bought when prices were high and sold when panic struck. The market didn't care about them. It rewarded anticipation, patience, and knowledge, qualities most retail investors lacked. The largest holders, the whales, controlled price movements. When they bought, prices rose. When they sold, markets crashed. The narrative of decentralization remained, but power quietly concentrated in the hands of a few. Altcoins exploded after Bitcoin's rise. Ethereum promised smart contracts. Ripple promised instant banking. Litecoin promised faster payments. Each promised to change the world. Few delivered. Most created a speculative frenzy. ICO mania of 2017 let anyone raise millions with a website and a promise. White papers replaced working products. Marketing replaced fundamentals. Millions poured in, chasing dreams. Most projects failed, leaving investors empty-handed. With complexity came leverage. Exchanges offered 10x, 50x, even 100x positions. What was once a long-term experiment turned into a casino. One wrong trade could wipe out savings, yet thousands jumped in, chasing overnight fortunes. Every crash revealed the same truth. Crypto magnifies human emotions. Greed and fear dominate. Rational investors were outnumbered by those chasing hype. Despite promises of self-custody, most users handed over private keys to centralized exchanges. Convenience won over freedom. Once again, power concentrated in centralized hands, the very thing crypto was designed to eliminate. When major exchanges collapsed, millions lost access to their funds. Savings evaporated overnight. Trust was destroyed. The technology was revolutionary, but human mistakes remained constant. History repeated itself. Greed, lack of transparency, blind trust, the same mistakes from traditional finance resurfaced in the crypto ecosystem. Technology had changed, human behavior had not. Crypto is not a simple story of good versus evil. It is a mirror, a reflection of human psychology. Greed, fear, ambition, and the constant desire for shortcuts to wealth are all magnified in the digital realm. Even with powerful technology, mistakes persist. Mismanagement, fraud, scams, and overconfidence dominate the story. The system is not broken, humans make it so. Governments have noticed regulation is arriving slowly but surely. Exchanges are being scrutinized, laws are being written. The freedom promised by crypto is now confronted with reality. Oversight is inevitable. FTX, Luna, and countless others demonstrated the fragility of the system. Billions vanished. Trust evaporated. Investors learned a harsh lesson. Crypto is powerful, but unchecked, it is dangerous. Why do 90 to 95% of people lose money in crypto? Because they chase hype, follow emotions, ignore fundamentals, and enter markets too late. Knowledge, patience, and discipline, these are the rarest assets. Crypto rewards early adopters, informed participants, and those who understand risk. Most others are left vulnerable. It is not evil, it is just math, impartial and unrelenting. Complexity hides risk. Advanced tools, derivatives, and leverage be the illusion of opportunity, but hidden beneath is volatility and uncertainty. The more sophisticated the system, the greater the potential for losses. Every cycle teaches the same lesson. Emotion is the enemy of profit. The market doesn't punish because of technology, it punishes because of human nature. Crypto mirrors our psychology. Our desire for wealth, shortcuts, and security are amplified. It shows us who we are, and sometimes who we are not willing to be, disciplined, patient, and rational. Despite the chaos, crypto has undeniable potential. Decentralized finance, smart contracts, global accessibility, these are real innovations, but they coexist with scams, greed, and mismanagement. The future is uncertain, but the technology is here to stay. Ethereum introduced smart contracts, allowing automation of financial agreements without intermediaries. This innovation created new possibilities, from decentralized exchanges to NFT markets, changing the landscape of digital finance. NFTs promised ownership of digital art, music, and virtual land. Millions invested. Some created fortune. Most were speculative bubbles. The lesson remained: technology is powerful, but human behavior defines outcomes. Market manipulation is real. Pump and dump schemes, fake news, and social media hype influence prices daily. Technology cannot prevent human deception, it only magnifies its impact. The blockchain itself is immutable, transparent, secure, but it doesn't stop greed, it only records it. Every scam, every error, every triumph is permanently etched in the ledger. Emotion drives decisions. Fear and greed dominate. Most investors enter at the peak of euphoria and sell at the depth of panic. The cycle continues. Whales continue to influence markets. Exchanges, wallets, and insiders could move markets with a single transaction. The system is decentralized in theory, centralized in practice. Crypto is not evil. It is math, code, and trust combined. But humans bring ambition, greed, and mistakes. The promise of financial freedom is real, but so is the risk. Ownership is power. Those who control keys, wallets, and private information hold the ultimate advantage. Convenience often comes at the cost of true control. Crashes are inevitable. Speculation will always bring volatility, yet history repeats, teaching those who listen and punishing those who ignore. Crypto has changed finance forever. Global transactions, decentralized systems, permissionless networks, these innovations cannot be ignored. But with great power comes great responsibility. Ethereum's smart contracts created new opportunities: decentralized exchanges, lending platforms, and tokenized assets. It promised automation without intermediaries, but complexity increased risk. Most users didn't fully understand what they were entering. Decentralized finance, DeFi, offered financial access to anyone with internet, but it also created invisible traps. Bugs, hacks, and scams became commonplace. Transparency existed, but knowledge was rare. Security became a central concern. Billions of dollars were lost to exploits. Code cannot think. Humans make mistakes. Technology is flawless only when humans are cautious, patient, and disciplined. Market psychology dominated outcomes. Every bull run attracted FOMO, fear of missing out. Every crash induced panic. Rational investors were outnumbered by those chasing hype. Whales continued to dominate. Exchanges, wallets, and insiders could move markets with a single action. Decentralization was ideal, but wealth concentration remained. Complexity hides risk. Leverage, derivatives, and tokenized products created layers of speculation. Those who understood the system thrived. Those who didn't were trapped. Crashes repeat patterns. Human emotions, greed, and fear are constants. Technology magnifies them but does not eliminate them. Awareness is the only defense. Crypto is global. Borders don't exist in the digital realm. Transactions occur in seconds across continents. Freedom and access are unprecedented, but so is risk. Governments now step in. Regulation is increasing. Exchanges are scrutinized. KYC and compliance measures are becoming mandatory. The promise of unregulated freedom faces the reality of oversight. Ownership is power. Those controlling keys and wallets hold the advantage. Convenience often sacrifices control. True freedom requires responsibility. Crashes are natural in an unregulated, speculative environment. They are painful lessons repeated over and over. Investors must learn patience and critical thinking. Crypto is an ecosystem, not just coins. Bitcoin, Ethereum, DeFi, NFTs, and altcoins form a complex web. Each affects the other. Understanding interconnections is key to navigating it. The blockchain is immutable, transparent, and permanent. Every transaction, every scam, every success is recorded forever. Patterns emerge for those who know how to read them. Emotion drives decisions. Fear, greed, and hope dominate most retail investors. They buy at peaks, sell at valleys. Discipline and strategy are rare. Manipulation exists. Pump-and-dump schemes, hype cycles, and media influence control market behavior. Technology does not prevent it. Human psychology does. Most investors fail not because of technology, but because they underestimate risk, overestimate knowledge, and overcommit emotionally. Crypto has redefined finance globally. Accessibility is unparalleled. Anyone, anywhere can participate. But freedom comes with responsibility, knowledge, and awareness of risk. Crypto has redefined finance globally. Accessibility is unparalleled. Anyone, anywhere can participate. But freedom comes with responsibility, knowledge, and awareness of risk. Volatility is inevitable. It is the heartbeat of the crypto ecosystem. Those who understand it profit. Those who ignore it fail. Decentralized finance promises inclusion and innovation, but complexity hides risks. Hacks, bugs, and scams can destroy wealth instantly. Knowledge is survival. Adoption grows. Merchants, institutions, and governments are slowly integrating crypto, but adoption does not remove volatility or risk. NFTs transformed art, music, and collectibles. Some created fortunes, most were speculative bubbles. The lesson remains: innovation does not guarantee profit. Whales dominate markets. Their movements create surges and collapses. Decentralization exists, but wealth concentration defines outcomes. Every market cycle repeats history. Emotional trading, speculation, and greed drive crashes. Awareness, strategy, and patience define survival. Human emotion is amplified in crypto. Technology magnifies it but does not create it. Understanding behavior is key to long-term success. Crypto is a web of interconnected systems. Bitcoin, Ethereum, altcoins, DeFi, each affects the other. Navigating this system requires knowledge and patience. Calm, rational investors outperform those who chase hype. Timing, discipline, and understanding cycles define success. Complexity creates risk. Layered financial instruments, leverage, and derivatives magnify gains and losses. Without knowledge, one is trapped. Ownership of private keys is power. Exchanges and wallets provide convenience, but true control requires responsibility. Crashes are inevitable. They teach discipline. They reveal greed. They separate the prepared from the unprepared. Crypto is global, decentralized in technology, but centralized in wealth and power. Understanding these nuances is essential for survival. The blockchain records everything: scams, successes, and failures permanently. Patterns emerge for those who observe. Emotion is the enemy of profit. FOMO and panic dominate most participants. Rational, informed decision-making is rare. Power concentration remains. Whales, early adopters, and insiders influence outcomes. Decentralization exists, but reality is nuanced. Market cycles are natural. Bull runs and bear markets alternate, amplified by human psychology. Understanding them is key to long-term success. Discipline, strategy, and patience outweigh luck. Understanding risk is more valuable than chasing hype. Smart contracts automate financial agreements, creating efficiency and innovation, but complexity hides risk. Understanding is mandatory. Control of assets requires understanding private keys, wallets, and security. Convenience comes at a cost. Crypto adoption is growing. Institutions and governments are integrating systems, But volatility, greed, and human behavior persist.
NFTs transformed digital ownership. Some gained wealth, most faced losses. The lesson? Innovation does not guarantee profit. Human psychology does. Whales continue to dominate. Market influence is massive. Retail investors must understand dynamics before participating. Every crash repeats history. Emotional trading and speculation are constants. Discipline and strategy define outcomes. Crypto reflects human psychology. Fear, greed, impatience, these define most outcomes. Awareness and discipline create winners. Crypto is an ecosystem. Each coin, contract, and protocol affects the others. Navigating this system requires knowledge and patience. Discipline, strategy, and patience separate winners from losers. Knowledge outperforms luck in crypto markets. Complexity creates risk and opportunity. Knowledge is the key. Without it, investors are trapped. True ownership means understanding security, wallets, and private keys. Responsibility is freedom. Crypto has changed finance forever. Global access, decentralized networks, and innovation are real, but risk, greed, and human errors remain constant. The future of crypto is uncertain but promising. Technology offers freedom, access, and innovation, but success requires knowledge, discipline, and awareness. Crypto mirrors humanity, brilliant, flawed, and endlessly fascinating.